Thanks everyone for joining. My name is Craig Tesman. I'm a managing director in the Houlihan Lokey's Financial Institution Group in New York. I focus, along with my colleagues, Arik Roshkes, Jeff Ballerman, and Juan Guzman on the insurance sector. I'd like to welcome you to HL's Insurance Private Equity webinar. As part of our effort to bring some valuable content, hopefully valuable content to our clients and contacts in this unprecedented time, this is our second webinar. So we've hosted a webinar about a month ago, where we brought together some senior insurance executives to speak about the current environment in light of the pandemic, and to give their thoughts on their view on the industry and where it's going from the insurance company operational side. Today, we'd like to take a different perspective, and that of the long-term investors or the investors in the sector. And so to that end, we brought together 3 seasoned and successful insurance private equity investors to provide their views on the challenges and opportunities as they see them in the current marketplace from the investor side. I'm very pleased to introduce our panelists today, Brad Cooper from Capital Z Partners, Keone Schwartz from Altamont Capital, and David Winokur from Towerbrook. Each of these gentlemen have made successful investments in the space, and we're glad to get their insights today. The format for today will be a roundtable discussion on a handful of topics for about 25 to 30 minutes. Then for about 10 minutes or so after the topic discussion, we'll then open up the floor to questions from participants, which can be submitted through the Zoom app. So feel free to submit any questions you may have. Before we get into the discussion, why don't we just take a few minutes to go around the table here and allow Brad, Keone, and David to give us their backgrounds and a brief overview of their organizations. And then once we've done that, we can dive into the topic discussion. So I don't know, Brad, if you want to kick us off.
Sure. Thank you very much, Craig. Good afternoon, everybody. I'm Brad Cooper. I'm one of the founding partners of a private equity fund called Capital Z Partners. We began this business about 30 years ago, focused on private equity investing in the insurance space. Over the years, we've expanded our focus to include financial services broadly, but the area that we have spent most of our time and invested most of our dollars is insurance. Including underwriters, brokers, and insurance services businesses. Over the 30 years, we've made over 45 investments, putting about $3.5 billion to work in financial services. And I wanted to thank you, Craig, for the invite to participate today. Being one of the old guys in insurance private equity, I'm asked to speak a lot, and rarely is there a topic as newsworthy and relevant as COVID-19 to speak about. It's clearly shaking up the industry. I'm excited to share what we've been seeing over the past 3-4 months with everybody, and I'm equally excited to hear from Keone and David what they're seeing, because I know that we have a lot to learn as well. So with that, I'll turn it over to David.
Thanks, Brad. And thanks, Craig and the Houlihan team for including me in this panel. Towerbrook, we're a private investment firm. We manage approximately $14 billion of capital. We came together as a team in 2005. Originally, we just invested, really in control private equity and on a control basis in the mid-market. We've broadened our mandate over time such that the same investment team invest really 3 discrete pools of capital: a $4.25 billion control-oriented private equity business, a $1.1 billion structured opportunities business that's really a highly flexible pool of capital that can do anything that we think is interesting but doesn't fit within the 4 walls of conventional private equity. And then we have a separate account and really an investment partnership with Ascension, who is one of the largest not-for-profit health systems in the country, where we look for things that they would define as strategic but not core. And there tends to be a lot of overlap with what we look at in insurance. I've spent my entire career investing in and around financial services, not just in insurance, but asset and wealth management, financial technology, banking, especially finance, and the like. We tend to take a very thematic approach to investing. So we really get excited about specific ideas and then work really hard to develop those ideas over a number of years.
Great. So, Craig, I can introduce myself, but thanks to you and the team. I'm certainly glad to be here. By way of introduction, I'm Keanu Schwartz. I'm one of the co-founders and I'm managing director at Altamont Capital Partners. We're also a mid-market private equity firm. We're based in the San Francisco Bay Area. Started the firm back in 2010, though have been working with my co-founders for close to 2 decades now. We manage about $2.5 billion across 3 different funds. Our current fund is about $1 billion. Few things about the firm that we at least like to think are a bit more unique about our approach. One is that we're very focused on fundamentals and business building. So the background of the firm is as consultants and as operators, not as investment bankers or traders. Not meant to be pejorative, but that's just where we come from. My first client, actually, as a consultant way back when, was Great-West Life, the insurance company. So I've been doing it for a long time. And we focus our returns on growing profits over time and through cycles, not through financial engineering. We've got a long-term focus. So our fund life is 17 years, which is very, very helpful for insurance investing, obviously. Allows one to hold through cycles. And while we're a generalist firm overall and have investments in a lot of different sectors, we have deep experience in certain verticals, and certainly insurance and insurance services is one of those. So at Altamont, in our predecessor firm, where I also ran the financial services practice, I think we've made 10 different insurance platform investments, close to 50 investments in total in the space, and those span the value chain from distribution to underwriting to claims and TPAs to carriers and reinsurers, so both balance sheet and non-balance sheet businesses. And currently within the portfolio at Altamont, we've got 3 different insurance platforms, one in the life and annuity space, one that's a personal lines MGA, and then most recently a vertically integrated platform that targets some small and medium enterprise risks in the UK and the EU. So excited to be here and to at least share some of our thoughts.
Well, great. We appreciate you guys coming and joining the webinar and bringing your experience and your insight. So let's jump into it. So topic number 1, I'd like to get your views on the impact the current pandemic may have, maybe in both the short term and the long term, on the industry. So for example, this is a very unprecedented event, which has the potential to impact multiple sectors across insurance, from life and annuity to health insurance to P&C, both on the personal line side and the commercial side, as well as the health of insurance balance sheets, and potentially major impacts on distribution. What do you think the impacts will be? And more importantly, are some of these going to be short-term or permanent changes? And are views of risk in the industry going to change, much like they did for pre and post 9/11, when folks had understood that they had concentrations of risk that they didn't understand in their portfolios? Is something likely to happen here today? So maybe we go back in reverse order. And Keone, if you want to start with your thoughts, and we can jump into this topic.
Yeah, no, it's honestly a little bit hard to know where to start. The impact has obviously been far-reaching across the value chain, and it's hard to imagine segments of insurance or more broadly where it hasn't been impacted. I think your framework is good to think of it as kind of short-term, primary impacts versus things that are longer-term, or secondary impacts. And obviously in the short term, there's a lot of things that are very tangible and hitting us and our portfolio companies right now, right? I mean, things like business interruption insurance and BI claims, which are kind of still working through all of the relevant jurisprudence systems across the world. We've had some distribution channel disruptions, in particular, some of our companies that were more reliant on brick and mortar retail distribution in the past with the lockdown that caused a decline. And then on the life and annuity side, we've had some sharp asset value declines, although the stock market seems to have recovered pretty quickly from those, but certainly at the end of the first quarter. What we like to try to do, at least, is think more about some of the longer term implications in insurance and the rest of the verticals we focus on. For that, there's obviously a number of trends. I mean, we've been looking at things like the acceleration of digital, right, and the need to service customers remotely across the value chain. That was obviously already in process, and I think, is only going to be accelerated. On the life and annuity side, we've looked a lot at how a much lower for much longer interest rate environment is going to influence product design, investment strategy for our companies. And then I'm more in P&C, right? And you mentioned this a little bit earlier, but in terms of looking at different ways to think about risk going forward, does this create opportunities, for new coverages, as an example, or new programs to address, future potential pandemics? So, yeah, like I said, we've for all of our portfolio companies, there's a multitude of impacts, and I think a lot of themes to think about as we consider new investments.
Maybe David, you want to?
Yes, I think Keone made several good points. I think it's really unknowable is the answer. I think we're still at a place where we're getting more and more information every day. If you think about insurance as a business, where ultimately claims take a long time to sort of develop and show themselves. I think anyone that sort of knows what the ultimate loss here is, and feels like they can bookend that loss, I'd like to spend more time with them, because I think we're certainly not sure. But there's no question there's a here and now opportunity in property and casualty insurance. I think what's interesting about this cycle relative to maybe historical cycles is there was rate hardening broadly across property and casualty entering this cycle. And I think it was the result of years of, underpriced risk, increases in attritional losses across lines of business. And so I think, the insurance industry was already waking up to pricing appropriately and trying to get a better handle through data and monitoring the risks that they had on their books. And I think this accelerates all of that. I think, it's interesting. Insurance is not different than really any other pocket of the economy insofar as there's a Darwinian effect that is happening as a result of COVID. And if you weren't digital before, this is certainly a call to action. So I think it's very much impacting, distribution, client interaction. I look at like life and health distribution and brick and mortar boots on the ground distribution, where you're selling products to older demographics. I can't imagine they're that comfortable having face-to-face conversations, not just when we get sort of out of COVID, but I think there's probably permanent behavioral change here that we're likely to see. And so we are, very intent watchers of what's going to happen, and, looking to make, take advantage from an investment opportunity standpoint. I just think we don't know yet what's to come.
Yeah, no, I think I agree with that. Pivoting to the next topic, maybe Brad, and we kind of touched on this a little bit with David and what Keone were saying, but what do you think are some of the exciting either challenges or opportunities from an investment standpoint that you think may come out of this dislocation? Obviously, we know it's difficult to understand today exactly what's going to happen, but when you're thinking about the world, where are you thinking there may be interesting place to play from an investment perspective?
Yeah, so I think this is a little bit like the insurance industry post 9/11 and post Katrina, Rita, and Wilma. I think as an investor in the insurance industry, opportunities arise in response to crises, and just like the pandemic is affecting every aspect of your life, it's affecting every aspect of the insurance industry. But we think property casualty is the area that's most interesting because it's most affected. As David said, we started thinking about the life health sector, but the asset recovery diminished, in our view, a large portion of the opportunity there. But on the property casualty side, not only do you have the asset valuation issues, but you also have the claims issues. And while I agree, it's hard to bookend, the extent of this loss. You are hearing from some very highly credible people numbers, beginning with 100 billion on the loss side. So both Lloyd's of London and Evan Greenberg have put their stakes in the ground at 100 to 150 billion dollars, which would make this a significant loss. In and of itself enough to, change the dynamic of the rate environment. But on the heels of, as David said, kind of 3 bad years in the industry, what we're hearing from people is the market is turning very significantly and very broadly. I mean, obviously there are certain lines of business that are going to be more impacted than others. But this is a pretty broad rate strengthening occurring. And so what we're doing is we're looking at providing capital to existing platforms where they might need some equity to fill the hole that they may experience from losses related to COVID. We're looking at giving growth capital to companies whose platforms may not have much exposure to COVID, but may be able to take advantage of the hardening rate environment. And then, of course, there's a lot of focus being applied to newcos, as there always are when a crisis in the industry occurs. So those are the three major areas where we are spending our time.
That makes sense. Pivoting just a little bit now, I guess we've talked a little bit about what might materialize in terms of new investment opportunities. To what extent, and maybe this is for you, Keone, to what extent are you actually seeing deal flow today? So we're talking about prospective opportunities, which frankly may take many months or many years to really fully develop given the pace of this pandemic. So maybe pivoting to exactly what you're seeing in the market today, I think we all understand that the market's, at least relative to 6 months ago, from a transaction standpoint, has slowed considerably. Although we're still seeing things in market, we still at Houlihan Lokey, within FIG and more broadly within the firm, still have things in market. Things are getting done. So I'm curious, Keone, from your perspective, what are you seeing in terms of current deal flow today?
Yeah, look, I mean, I think everything certainly seemed to die down for a couple of months, and we're still not back to anywhere near where we were pre-COVID. A number of processes, as you guys know well, were pulled or delayed. But it does feel like it's starting to pick up a bit more. And in particular, I think, as Brad mentioned, for some of the de novo players, we've seen at least probably a dozen different ideas in various stages. Whether on the E&S side or reinsurance or fronting carriers. A few of which have gotten funded and others that are kind of in market or coming to market. So that does seem to be, an active source of deal flow. For us personally at Altamont, we're actually still pursuing a number of add-ons for our existing portfolio companies. A lot of these are pretty small and mostly generated through our own network as opposed to broader processes, so we can kind of continue those conversations through this pandemic. We're seeing a number of books of business, in particular on the life and annuity side, but some other corporate carve-outs. It feels like many of the large insurance carriers are repositioning their portfolios. They're looking at potentially redeploying capital and resources, and so I think there will be some opportunities coming out of that. And then I guess the last area that we're seeing a couple opportunities is that as a firm, we tend to be a bit more comfortable with kind of complicated situations. And we're also open to looking at creative structures, investing up and down the capital stack. So we've had a number of discussions with businesses that you could say were stressed, if not distressed, and there was more of a catalyst to have conversations now. But certainly the regular way deal flow, that I think we were all used to over the last decade or so, has dried up.
David, would you care to comment?
So no question, we're seeing significant number of opportunities around balance sheet formation and recapitalization, type investments of existing platforms. As a point-to-point investor, I think what we're trying to wrestle to the ground is, how much of this is like a post 9/11 type environment where you're going to have 7, 8, 9 years of elevated rates, or does the industry recapitalize itself, very quickly, such that it's more sort of fleeting in nature. So I think that, the stuff that we've been more interested in on that score is a little bit more opportunities where we feel like there is sustainable franchise value that probably means more in the U.S. specialty onshore space. I would say we are seeing, on the distribution and services side, we are definitely seeing the iceberg thaw. We are seeing deal flow again since COVID. I mean, it's hard to believe it's been 3 months already, but since COVID, first sort of occurred, we have now lost, I would say 2 or 3 deals that were in healthy businesses that we liked because we weren't yet in a place where we were ready to go see those companies. in person. We had done lots of diligence, virtually. And so we as a firm have just changed our policy in terms of, facilitating more face-to-face interaction, but we are definitely seeing healthy companies come back to market. I would say more so in sort of founder and management-led situations than necessarily sponsor-controlled situations. But we are, for businesses that are healthy and are going to do well as a result of COVID, and there are a few of those. We're certainly willing to lean in, and I think you're starting to see that more broadly.
Great. Actually, that segues well into my next topic, which is, to what extent are you seeing processes changed? And these transaction processes, obviously, in this virtual environment, are very different. And maybe pivoting back to you, Brad, you said you've been looking at a number of opportunities. Are you able to do that virtually? And what's your view on how long can we do that? I mean, obviously, we've been running some processes at Houlihan, both within our group and in others, where it's been a virtual management presentation process, and that gets you it's far enough, I think. And I think it remains to be seen whether that you can get all the way there, or when are you going to have an in-person meeting? I mean, any thoughts on how that's changed the diligence process, at least from your perspective?
Yeah, look, investing in the insurance industry is very complicated, especially relative to investing in other non-financial services businesses. So, given those complications, our view is that you've got to be able to do on-site due diligence. The idea of conducting diligence virtually and bidding on a company based on kind of remote diligence process, to us, does not make sense. We would not, we would not go to our investors and say, we were happy to have secured this deal, which we've diligenced over the past 2 months, but haven't been to the company's business and had several meetings with management. Well, but what we are so as a result of that, where our real focus is, Keone mentioned add-ons, right? That's a great opportunity. If you have a business that well inside and out, and you have a very good handle on how that business is going to be impacted by COVID, why not put more money into that business to either grow it or to allow it to make acquisitions of one of its competitors it may know well enough? The other thing that we're spending time on are businesses that we've already done due diligence on, right? So lots of times, when you're a sector specialist like us, you go out and you meet companies, they're thinking about raising capital, you can't reach terms, but 6 months later, you're able to go back to them. At that point, you could probably dust your diligence off and do it virtually and feel pretty comfortable you got your arms around the situation. I was hoping to be able to share the details of a deal that we announced today, specifically. Not quite there yet, but we're closing today on a $100 million investment in an insurance company that fits that mold, where we've invested with the CEO twice before. We did due diligence in his business when he formed it several years ago. We did due diligence in his business a couple of years ago when he raised capital. In both of those scenarios, we, for various reasons, declined to participate, but now feel the market opportunity is such that investing in him and his team makes sense. And so, that's how we're able to get comfortable putting money to work in the market today.
Well, that's great. Congrats, and we look forward to seeing the deal when it's announced.
Thank you.
Maybe just final topic before we pivot into Q&A. Keone, can you speak to any steps you've taken with your portfolio companies to best position them for coming out of this downturn and how to capitalize on opportunities and growth? I mean, we discussed add-ons. Is there anything you're doing with the management team and with the companies themselves just to position them best for coming out of this pandemic whenever the recovery gets going again?
Yeah, no, it's a good question. I think in general, we've been fortunate that our insurance portfolio has not been significantly negatively impacted, and certainly relative to some of the other businesses in the Altamont portfolio, in retail and consumer-facing sectors. As an example, we're an investor in a terrific business that's a dine-in movie theater concept, and you can imagine what has happened to sales there, and it was literally overnight, right? So I feel fortunate in the insurance sector, at least, that that we haven't been as impacted. But having said that, we've done, I think, what most other private equity firms and owners have done, I'm sure, which is, we've reinforced the importance of cost controls and liquidity across the board. In general, we were fortunate we didn't have as much financial leverage, so didn't in our insurance businesses. So, not a lot of covenant negotiations or things like that, and pretty well positioned. But I think the main thing, what we've tried to reinforce with our companies is to try to free up resources and capital to focus on the areas of opportunity coming out of this, right? What are the ways to play offense? We've been fortunate. We've completed, I think, 4 add-on acquisitions in 2020. We've introduced a number of new product offerings and some programs across our portfolio companies. So really, it's about continuing to try to anticipate where the puck is going, right, versus where it is now, and make sure the companies are well positioned, not dissimilar to what we're trying to do as a firm.
Got it, David. I don't know if you want to add your comments.
Yeah, maybe I'll provide two examples. So we have a platform called Orchid, which is a managing general agency, managing general underwriter focused on coastal E&S markets. We want to give that company more ways to win. We're seeing just tremendous rate increases in the markets in which we operate through the first 4 months of the year. The business grew revenue 21% year on year. It's done a good job attracting new capacity, but really I think it speaks to just how robust the markets in which it's operating are right now from a rate hardening standpoint. So we've done 2 things. We expanded a collateralized, reinsurance captive is the way to think about it, where we can use a little bit of our own capital to create, a significant amount of capacity. We work with one of the fronting companies and place reinsurance on top of that vehicle to, really expand probably the premium base of the company by 15 or 20%. We also, it's not yet announced, but we have finalized a joint venture with a very large, insurance company in the United States to form a reciprocal, which will write business in the admitted market. Orchid is today, entirely an E&S focused company. We think that's a great structure at a very interesting time in the world to deploy that source of capital. And then related to insurance, we own 2 litigation finance companies focused entirely on commercial B2B litigation. We're seeing a huge spike in demand for litigation finance in both platforms. I would say the quality of the deal flow and the pipelines have expanded pretty materially. So in one of the platforms, we've expanded our capital commitment there with the idea that the opportunity set in front of that company has gotten better, not worse.
That's great. And it's really wonderful to hear that deals are still getting done in this environment. You guys are busy and you guys are kind of positioning yourselves well for whatever comes next. So I'm glad to hear that. Jacob, my colleague Jacob's on the line. We're going to open this up now to some Q&A for participants. So Jacob, do you have a list of some questions from folks?
I do, Craig. Thanks. So, first off, what have dialogues been like with, both lenders and LPs during this time?
Brad, maybe you want to take that.
So I'll address LPs. Maybe one of these guys can address lenders. We're not heavy use of leverage in our portfolio companies, and we have a very small portfolio now, having sold off a lot of investments over the past couple of years. That got the timing right because we had felt the asset values had just kind of reached peaks. But I mean, the conversations we're having with our LPs are exactly what you would expect. I mean, people are wanting to know how this situation is different than the credit crisis of 07, 08. So we're talking to them through that. And as I addressed earlier, our LPs are curious about how we're getting diligence done on companies that we're looking at. So we've been very clear with them that we don't intend to do, we don't intend to kind of involve ourselves in an auction process where we're not going to be able to, spend time getting to know the company, getting our arms around all of the diligence issues, until we can get back to meeting with people face to face. So that's the conversations with LPs, and I think they're hearing that, you know, consistently from most of their GPs, and they're pretty happy to hear that.
Great. Tony or David, you want to address the lender side?
Sure. Like, I mean, I mentioned earlier, we don't have a lot of financial leverage on our insurance investments, but, you know, we have a big portfolio, and so have seen their behavior. You know, it really depends on the firm. I think that sometimes, you know, specific banks reacted differently than some of the non-bank lenders or BDCs. But I think from my experience, at least at this point, people did accept kind of the reality of COVID's impact at different points in time, and before too long, it feels like almost everyone has understood, you know, the magnitude of the disruption and the need to be flexible and pragmatic. Right? It was about solving for liquidity up front, and then over time, really thinking more about covenants. But actually, been pleasantly surprised with. There's certainly been some painful conversations, but pleasantly surprised with how the lending community has reacted over time.
That's great. Jacob, do we have another question?
Yeah. So this is going to be a bit broader, but so in general, how has your investment thesis around insurance changed as a result of COVID-19?
I don't know, David, if you want to take that. The
Sure.
answer would be it hasn't, but
No, I think you know, it's interesting. I think we probably told ourselves we're unlikely to do an insurance balance sheet deal again, and I think that's now changed. I think 10-year period of time where, you know, we sort of felt like there were structural changes in the insurance industry that made that an unlikely place to generate, you know, 20% plus rates of return in insurance, and I think that's no longer the case. You know, I think it probably reinforces, you know, on the services side, so distribution and TPAs, I think it reinforces things that we were already working on, and hopefully provides a better entry point because the world's maybe a little bit more rational on pricing, and it's probably a good summation.
Brad, any thoughts you want to add to that?
Agree. I mean, I grew up as an insurance investor, and I thought my career was over. Maybe you know, the opportunity to invest in an insurance underwriting company, those have been few and far between. But everything we're spending time on now, or almost everything we're spending time on now, is that, and the deal that we closed today is an underwriter. And I do think that these changes are going to be, you know, more than short term. I think they do create opportunity to make good investments in underwriters that are, you know, private equity investments where you can make 20+% rates of return over a, you know, 4 to 7 year time frame. So, you know, we're busy. We're kind of licking our chops a little bit because that's really our sweet spot, and we're busy looking at a number of things.
That's great. Maybe time for one more question, Jacob.
Sure, and I think this will be geared more towards David. David, do you think lenders will quickly return to pre-pandemic leverage requirements, or are they going to remain very conservative into the near future?
I think it depends on the underlying business. I think, you know, we're in a world where capital in all private markets, whether it's private equity or private debt, is, I think, still pretty abundant. And at the end of the day, people need to deploy capital. I think people, you know, and you need to, you know, earn adequate rates of return. But I think it will be dependent on the underlying business is in the short run. And then, like anything, capital will sort of come back and people will be more aggressive again because they have to be. And so I think whether it's a year from now or 24 months from now, I think we're at least willing to sort of underwrite to the view that you know, the world will heal itself.
Danny or Brad, do you agree with that sentiment?
Yeah, I mean, frankly, we've been surprised by how quickly the capital markets have recovered. I mean, I suppose it's not shocking given the amount of dollars the Fed has pumped into the economy, and David's point, the you know, amount of capital that was already available. But yeah, and I think Brad mentioned earlier, I think some of the opportunities we saw, you know, on the life and annuity side, as an example, were, you know, only lasted for a few weeks, right, before markets started trading back. So yeah, we'll see.
Good. Well, I think that does it for today. Thank you guys for your time, Brad, Keone, and David. Thank you so much for participating. I thought this was a great discussion. For anyone that's joining the webinar that wants to follow up with any of these guys, just let us know at Houlihan and we can connect you. Just want to say thanks everybody for your time. It was a good discussion, and everybody have a good day.
Thanks.
Thanks,
Thank
Craig.
you.
Thanks, guys.